Now, and Varun Lohchab from HDFC Securities is joining us now. Varun, good morning. Thank you for joining in. In your very recent note, you have mentioned that risk reward is turning increasingly unattractive and you are advising to remain cautious on the road ahead. And now a lot of people would ask you that what should you be buying? But we'll flip the question a little and say, if you're saying that the risk reward is getting unattractive, which are the pockets where it is happening so?
Yeah, good morning. So, so in this recent note, we again highlighted that, there is a sort of euphoria or over optimism building in, especially in mid and small caps. But at the same time, even in a lot of large caps, we have seen significant re-rating and stocks trading ahead of fundamentals. So actually, I think more than the market cap, it's to do with certain segments. Obviously, industrials, cap goods, some of the PSU names, were more prominent in the list of names which are trading at significantly rich valuations. But again, when we say PSU, some of the really large PSUs with good free float, they are still trading at reasonable valuations. But a lot of the low free float PSUs, more thematic sort of companies, they have significantly re-rated, and we believe risk reward is unattractive there. So I think those are some of the pockets where there is clearly overvaluation sitting, whereas 2 or 3 pockets where valuations were relatively okay was one, banks, second was IT, especially large cap IT, and third was consumer staples, where relative to history and relative to rest of the market, these segments were looking slightly better from a risk reward perspective.
Varun, hi, good to have you on the show today. Just wondering whether Havells or Polycab, whether these stocks are under the coverage. Both are important mid-caps the market looks at and tracks widely, and both have missed expectations in the quarter gone by. Any thoughts here? And also sort of, single out for us any other important mid-caps in your portfolio where earnings have either come or something that you're really watching out for, important to watch mid-caps from your perspective.
Yeah. So Havells we do cover. We have an ad rating out there. Consumer discretionary, especially consumer durables, we have been positive in the last 3 to 6 months. So along with consumer staples, that's been one sector where we have turned more constructive in the past 3 to 6 months. Again, given the relative risk reward, and we believe that the demand conditions seem to be bottoming out even for consumer durables. But Havells had a very strong run from 1400 to 1900 within 3 to 6 months. So right now we don't have much upside left on our target price, but we have an ad rating. Polycab we don't cover, but Crompton Consumer is another sort of consumer durable play where we are positive among the mid cap names, and even Orient Electric. So consumer durables as a space we are positive. Consumer staples, as I said, we are positive. So names like Marico, Britannia, Dabur, which are actually large caps, but the second rung large caps after ITC and HUL, that's the segment which we are positive on. As I said, looking more at certain pockets and certain sectors, not, again in IT, mid-cap IT is something which we have not been too positive on off late, but large cap IT we believe offers better risk reward. And therefore, we have been shifting more towards that side in the last 3 to 6 months. So it's very sector specific.
Interesting you brought up IT. I was going to ask you just that, whether the excitement has already been captured in the stock price. I mean, the rally started building just before the numbers, right? TCS, Infosys, most of these stocks were up. What are your top picks, and whether you still think that there is more headroom left after the Q1 performance?
Yeah, so you're right that a part of the upside has already been captured, because you have to keep in mind that it's not that we have seen significant improvement in in the demand conditions in IT, just that we are now seeing clear signs of things bottoming out, which was looking like the case 2 quarters back as well. But then we had a scare in between after Q3, Q4 numbers, and now we seem to be again getting a sense that things are bottoming out. But if you look at the growth for even next year, still FY 25 and 26, the sector is not going to do anything more than 8 to 10% on earning growth levels, which means after this 20-25% kind of run up which we have seen in last 1 month, in some of the even large cap IT names. The absolute upside looks limited, but at the same time, with improving demand conditions, the downside also looks fairly limited in case of IT, given the quality of businesses, the cash flow they throw, and the valuations at which they are trading at. Some of the large cap ITs are trading at more like 20 to 25 times 1 year forward PE. So I think absolute upside, we might have captured 60 to 70% of that within last 1 to 2 months, but I think still it's a sector which is looking fine on a relative basis when we look at overall market, because there is a lot of overvaluation sitting in other pockets compared to IT.
Varun, you spoke of PSUs. I wanted to zero in on that a little, and you spoke particularly about the defense PSUs. And one of the stocks that you have highlighted in your report also is HAL. And not to talk, you may want to talk HAL specific, but the entire defense theme as a whole, they've seen a kind of run up which is, it's hard to justify, because stocks are up almost 200-300% in just the first 7 months of the year. And he recently had a domestic brokerage also downgrading these names, saying that even at the most aggressive earnings estimates, it's still very difficult to justify the valuations that they are at in. Would you rate the defense as one of those sectors where people should look to take money off the table? Because of course there is plenty of money already made, but over a longer term perspective, what's your call there?
So won't be able to talk on HAL specific, given we don't have a rating on the stock. But on the defense sector, and what we have highlighted in the note is a whole host of stocks where we have not seen meaningful earning upgrades, but the stocks have ran very hard in the last 6 month, 12 month, 18 month period, and where valuations are now significantly above long-term averages. Even if we were to ignore long-term averages, some of these stocks are trading at 40 to 50 times P, which seems fairly high, even if we have a long runway of growth, because there are going to be execution slippages. The margin profile of these companies is volatile and changes, from order to order. So it's difficult to forecast a very long-term sort of a picture, while they are going to compound at probably 10 to 15%, given the way defense spending is expected to continue to remain healthy. But we believe a lot of those positives and next several years of growth is already built in. So so what we are advising is caution on some of these segments. Railways is probably another such segment where we have seen significant re-rating and a lot of stocks trading at 40, 50, 60 P. Despite the long runway of growth, we believe at those valuations, once you buy, the probability of making sizable returns in the future gets diminished. So with that perspective, we are advising caution on some of these segments.
All right, got it. Good talking to you, Varun, today. Thanks very much. You have a good day and a good weekend, and we look forward to connecting again soon. Need to take a break. When we come back, an interesting discussion lined up. Jyoti Gupta of Nirmal Bang Institutional Equities is going to be joining in. Nirmal Bang has recently taken a very guarded call on the defense space. They have downgraded the sector, saying valuations are too high. We will get into that conversation in just a minute.